So the decision of where to live and whether to rent or buy is obviously an important one. It's important both from a financial perspective as well as a personal one. You want to live in a place that you actually like living in, ideally, if you can afford it. When it comes to buying, what you'll more likely than not need to do when you are looking at buying a house is get a mortgage loan. That is a loan specifically for the purpose of buying a house. So we're going to talk a lot about mortgages shortly. But one thing you'll want to look at before you go through the process of getting a mortgage when you eventually buy a house is to get your finances in order. So reduce debt to the extent that is possible and try and build up a cash buffer, because you'll need some cash when it comes time to buy a house. Even though you get a loan on a house, you'll still need to contribute some amount of cash. And another thing you'll have to consider is make sure that you can build up and protect your credit score using some of the methods that we've covered. If you can save money in an IRA or a 401k account, these are retirement accounts, that will be excellent. And the benefit is that you can still use this money as a down payment on a purchase of a house, even though it's in your retirement account. So this money will come in handy when it comes time to buy a house. There are some special benefits of owning a house from a financial perspective. One is that you can deduct the interest expense that you pay on the house from your income, meaning basically that if you own a house, you can pay less taxes than if you're renting a property. And then the other benefit is price appreciation. Though it's hard to predict on a year-to-year basis, generally speaking, over a longer horizon, say 5, 10, 15 years, home prices do appreciate. And so if you buy a house for $300,000, 10 years later you sell it for $500,000, you get to enjoy that house for 10 years, but at the end of 10 years, when you sell it for a $200,000 profit, that's a benefit that you could get that you wouldn't have been able to get if you had rented for 10 years. So it's definitely something to think about in terms of whether to rent or to buy. Now, another consideration is that of private mortgage insurance. Whenever you get a mortgage, a loan on a house, that's more than 80% of the value of the property, you have to get something called private mortgage insurance. And that's fine. It's just that it's this extra monthly payment that you have to make because you put down so little cash of your own cash yourself. So you can actually put down as low as 5%, sometimes even less, of the property value of your own money. So in other words, if you wanted to buy a $400,000 house, you could get that by putting down just 5% or $20,000. That's your down payment. But because you put down less than 20%, you'll have to buy private mortgage insurance, which is probably a couple $100s a month. However, if the value of the home appreciates after you buy it, if it appreciates by enough, say 15% or so, then you can just request that the lender cancel the private mortgage insurance, and they have to do that. So private mortgage insurance, you have to pay it if you have a small down payment, but you can cancel it within a year, maybe a couple years, depending on how fast property prices appreciate in the place that you buy. So get on the housing ladder as soon as you can. The way to do that is to save up as much money as you can now. It doesn't have to be a huge amount. If you budget carefully, you can save this much after a year or less within your first job after college. But sometimes renting can make more sense, whether that's just a temporary solution or a long run. You have to be able to decide what's going to be better for you personally. Let's first talk about some definitions related to that when we're talking about renting versus owning. First of all, rent, you're probably familiar with. It's just the monthly amount you have to pay in order for the right to use that space. And typically when you sign a lease, you also have to pay a security deposit. It's a down payment that you should get back as long as you pay your rent on time and in full, and you don't cause damage to the property. The security deposit and damage deposit are usually one and the same. The lease itself is the contract that specifies how long you're going to rent, at what amount, and what you are supposed to do versus what the landlord is supposed to do. Your lease is either going to be month to month, periodic tenancy, or it's going to be for a specific period of time, typically 12 months. Some leases allow subleasing and others don't. But subleasing is where you rent the property that you currently have contracted rent for. Say you don't want to live there, you can potentially rent it out to someone else instead, so that you're not liable for the cost. That's subleasing. Sometimes it's allowed by the landlord, sometimes it's not. As a tenant, you do have some rights. You do have the right to have a property in a reasonable state. If something breaks, like the sink starts leaking, for example, you have the right to have that repaired. And as long as you didn't cause any damage and have paid rent on time and in full, you have the right to get your security deposit back. So the monthly cost of renting can be cheaper than the monthly cost of having a mortgage. But over the long run, generally speaking, owning your own house is going to be less expensive than renting for a long period of time. You can own a house, single-family dwelling, in other words. You can also own a condo. That's like, an apartment in a high-rise. And a co-op is a similar thing. A more affordable option, not so much available in, say, San Francisco, is that of manufactured housing or mobile homes. You'll be more likely to see these out in the countryside. So, recap, based on cash flow, generally renting is cheaper on a monthly basis. However, with a property, when you buy a property, you get that long-run potential for price increases. That is, you can use it, but then over the long run, when you're done using it, you can sell it for a higher price. Price appreciation. And you also have the tax benefit. Let's say my mortgage payment is $4,000 a month, and of that, $3,000 is paid in interest. Per year, that's going to be $36,000 in interest, but here's how the deductibility works. I get to deduct that $36,000 from my annual income. So supposing I'm fairly successful here, my annual income is $100,000. Normally, I'd have to pay a tax rate on that of a certain amount. I may have to pay, say, $40,000 in taxes each year. But if I had a house and I had $36,000 in interest each year, I could deduct that from my salary when it comes time to pay taxes. And so instead of paying $40,000 a year, I'm only taxed on $64,000. So 40% of 64 is taxes of $25,000 and $600. So in other words, yeah, I pay $3,000 in interest each month, but if I'm saving, my taxes are going from $40K to $25K roughly, then I'm saving $14,000 a year in taxes. That $14,000 a year saved, that wouldn't come if I was renting. It's only a tax deduction that I can take if I'm owning a property. So when it comes to buying versus renting, the buying has in its favor taxes and the benefit of price appreciation. Now, there are some costs involved with buying a property that aren't there when you're renting a property. First are upfront costs. There are closing costs when you purchase a property. You have to pay taxes, you have to pay some processing fees for getting the loan done. These are all called closing costs. And closing costs, generally you can think of them as being about 1% of the property's value. So if I'm going to buy a $400,000 house, I need the down payment, plus I need around $4,000 to cover these one-time closing costs. And then the down payment is the portion of the purchase price that is not borrowed from the mortgage. That is the portion of the purchase price that isn't being paid for by a loan from the bank. By the way, you can have gift funds. So if you have a uncle or aunt who's especially generous and is willing to give you money, you can use that money for the down payment to help with the down payment. Okay, let's talk about mortgages a little bit. There are some things in the mortgage world, some vocabulary that's specific to the mortgage world. One is points. So sometimes you'll see mortgages available that look like they have low interest rates, but they come with points. These are fees, one-time fees, as part of getting the mortgage. 1 point is 1% of the total mortgage loan amount. So just because you see something with a low interest rate, a mortgage with a low interest rate, doesn't mean it's necessarily cheap if it's coming with points. And there's a trade-off between points and interest rates. Generally, it doesn't make sense to get a loan with points, and it's a lot easier if you comparison shop for different loans by looking at them without points. So try to find loans with 0 points. These are all part of closing costs. Attorney fees you may or may not have to pay, but you'll have to pay fees called title transfer fees, insurance fees. These will be things that'll come up as part of buying a house. Your loan person and your real estate agent can help you with this, though. Sounds daunting, but everybody does it during their life. You'll learn the ins and outs of each of these when you actually go and buy a house. Other fees, home inspection fee. Oftentimes it makes sense to have a professional come in and look at the house you're buying to make sure that there's nothing, like no major leaks, no major structural problems. I mean, you're making a big purchase, so you want to make sure that everything is good to go there. So oftentimes it can make sense to pay the $400 or so to have a professional home inspector come in and look at the place. An appraisal fee is required because if you're going to get a loan on the property, the bank wants to know what the property's worth. And you have to pay someone called an appraiser to come out and look at the property and give their estimate of what the property's worth. Again, there are a lot of closing cost fees when you go and buy a house, totaling probably about 1%. Don't worry on memorizing or trying to understand all of these. Just be aware that they're here, and you'll have to research more when you go and actually buy a property. But here's kind of what your monthly payments would look like, or monthly costs to consider when you're buying a house. You first have principal and interest. That principal is like some of the amount of money you pay each month on your mortgage goes down to pay off the loan itself. And then the remaining amount of money goes towards interest. A lot of money each month goes towards interest, which means the interest rate on the loan. If you have less than 20% as a down payment, you'll have to pay mortgage insurance. Sometimes you'll want a home warranty. That may or may not be something that you want. But what you'll definitely have to pay as well is homeowners insurance and property taxes. So the local government will tax your property. In California, it's 1%, approximately 1% of the property value each year you have to pay in taxes. So if you have a $4,000 or $400,000 property, you'll have to pay $4,000 in taxes each year. That stuff, that money goes and pays for schools, firefighters, police, just all sorts of city things. And then you have to pay for homeowners insurance. So, like, for example, if there's a fire in your house, homeowners insurance will pay for the cost of repair after a fire. Heads up, homeowners insurance doesn't cover earthquake coverage. But you add these three big costs together, principal and interest, possibly mortgage insurance, property taxes and homeowners insurance, and this is kind of your total monthly cost out the door of having a property that you bought. Those three things, when you combine principal and interest together, are often termed PITI. Some of these you can pay monthly, some of these you can pay twice a year. So taxes and insurance, you generally pay twice a year, unless you have something on the mortgage called an escrow account, in which case you pay a little bit of money to this escrow account each month. It's actually a fixed amount as part of your mortgage payment, and the money that goes into that escrow account gets emptied out twice a year to cover your taxes and insurance. So an escrow account could be nice because you just don't have to worry about forgetting to pay your taxes every 6 months, which I've done before on a property. Escrow account is also nice because sometimes if you have an escrow account on a loan, you can get a little bit better of an interest rate. Okay, those are the financials involved with the actual transaction process of buying a home. But let's look at how this home buying process works on a step-by-step basis. It's actually kind of a premeditated thing. I mean, before you buy a home, you should be kind of planning for that at least 6 months out. And the planning really that far ahead relates to getting your finances in order. You want to make sure your credit score is okay, making sure there are no errors. You want to make sure that you've got an idea of how much you can afford to pay each month for a mortgage. And remember, when it comes to looking at what your credit score looks like right now, you can visit Credit Karma to get a free view of your credit report, your credit score. 3 to 5 months in, that's when you can kind of start shopping for a mortgage. You definitely should shop around from different lenders and get what's called a pre-qualification letter. That gives you a sense of how much you can actually afford. They'll do the calculation for you based on your income. Just make sure you shop around. So go to a bunch of different lenders and mortgage brokers to make sure that you're getting the best interest rate that's out there. And then with that pre-qualification letter, you can begin to go shopping. Plenty of places to go and look for properties online, Zillow, Redfin. There are just a million places to go and look at properties online. Find a few that you like, and then you can go and visit them in person. That process can actually take a while. I've bought properties in as short a time as 1 month, but I've also spent more than 6 months looking for a property too. Once you sign an offer to buy a property, that's where the real fun begins. That's when you officially obtain your mortgage loan. So this is moving beyond the pre-qualification letter to actually getting the loan. And there's a lot of paperwork involved with that. But that'll come after your offer gets accepted for offering to buy a house. It takes about 30 to 45 days to finish this purchase process, but after that you can celebrate and move in. Some people have asked me about buying foreclosed properties in particular. These are properties that the person who was previously living there stopped making payments on their mortgage and the bank took it back. So the reason I get asked questions about this is because with foreclosed properties, you can sometimes get a better price because you're negotiating with a bank who just wants to get the house off its books, so to speak. You're not negotiating with the homeowner directly. Buying foreclosed properties can therefore give you a good deal, but really buying a foreclosed property is a more complex transaction. There's a lot more uncertainty involved. You have to do a lot more work researching that the property is okay to buy. There's just a lot more unknowns. So it's maybe not recommended for buying your first house, but if you do get really interested in real estate, buying a foreclosed property can be a good way to get a good deal. Last thing I want to talk about is just more details on the mortgage loan itself. So the amount that you pay each month when you get a mortgage to buy a house, it's going to depend on how much money you borrowed, the interest rate on the mortgage. The higher interest rate, the more money you have to pay each month in interest to the bank, and the length of the loan. If you have a 30-year mortgage, you have 30 years to pay that loan back. If you have a 10-year mortgage, of course you have 10 years to pay that loan back. You're going to pay a lot more each month to pay it off early with a 10-year loan than with a 30. So getting a longer maturity loan can lower your monthly payments. You can have either a conventional mortgage or an adjustable rate mortgage. Conventional mortgage is what 90% of people go with. It's got a fixed interest rate for the life of the loan, so you know exactly what you're going to pay each month for the next 30 years or for whatever maturity you pick. This is just generally the way to go. You can do something called an adjustable rate mortgage. What you get with this is usually a lower interest rate to start with, but the thing is that the interest rate can change over time. It can go up or down depending on whatever interest rates in the economy are right now. So if you got a variable interest rate mortgage right now, you pay a very low interest rate because interest rates in the US right now are quite low. But if interest rates in the US rose, the cost of your monthly mortgage would rise as well. This got people into trouble quite a bit during the 2007 through 2008 real estate crisis that occurred in the United States. A lot of people defaulted on their mortgage because they had adjustable interest rate mortgages. They had got these during, say, 2003 to 2005 when interest rates were low. After 2005, interest rates rose, and many of these people found that suddenly they couldn't pay their mortgages. So this is one of the factors that led to a big wave of housing defaults during 2008. So generally speaking, a conventional mortgage, fixed interest rate, no points is probably the way to go for you. There are some other options, but these options are really only when you can't find a simple fixed 30-year mortgage. Like if you just don't have that available to you. For example, there was a time when I was living in Texas as a student and I wanted to get a property, but I couldn't qualify for my income. My income was coming from a scholarship each year, so that money couldn't be used to qualify for a standard 30-year fixed. And so what I had to do was, when I bought a house, I negotiated with the seller to finance a mortgage for me. That is, I paid the seller a monthly principal and interest each month. And then I was able to own a house. But again, these are sort of unusual situations. 95% of the time, you'll be able to go with a standard 30-year fixed mortgage. These ones are also much more expensive. Now, when it comes to selling that home that you eventually buy, you can sell it yourself or you can pay a broker to do that. If you work with a broker, what you do is called a listing agreement. And what happens is that the broker will list it on something called an MLS, multiple listing service. And so it makes sure that your property for sale gets advertised to a lot of different eyeballs. It'll show up on Zillow and Redfin and all of that. That's really beneficial. Oftentimes it can make sense to use a broker. Just understand that the transaction costs are really high. So when you sell your home and you sell it through a broker instead of yourself, you often have to pay a 6, possibly even 7% commission. You can negotiate this with the broker though, so definitely shop around. Again, Redfin tends to offer like discount brokers commissions, but yeah, it can be expensive to sell a home. 6% of a $400,000 home, that's a $24,000 commission that you have to pay upon sale. By the way, when you're buying a home, you don't have to pay these commissions. It's the seller that pays the commissions. Now this is actually not true. Most mortgage loans don't have a prepayment penalty. So buy it, hold it for a year, no problem. You can still sell it. You're not restricted from selling it just because you have a loan on it. So this was just a brief overview, but I think the conclusion is that home buying, definitely some benefits there, but there's a lot more in the process of home buying that you need to be aware of. Some complicated financial details, such as figuring out your monthly cost and figuring out how much money you can really make from buying a house versus what you're paying renting right now. To do that, you'll have to think about the tax benefits, and then you'll also have to think about what you'll be able to sell it for sometime down in the future. So that's another thing to think about when you're thinking about buying a house. Think about how long you're going to live there. Generally speaking, if you're going to live in an area for 5 or more years, then the financial trade-off seems to fit more in favor of buying a house because it's more certain that you're going to receive some property price appreciation. So factor that property price appreciation into your calculations when you're looking at buying a house.